Hello, everyone. Today on the Final Bar, we'll do our normal Monday routine, hitting the market from three directions: top-down macro, sector rotation, bottom-up stock picking. We'll hit on some of the key charts in each of those three important areas, set you up for success for the remainder of the week. The S&P, I think the key word for today is distribution, with the S&P opening higher, but sort of selling off going into the lunchtime, really accelerating to the downside into the close. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a somewhat hazy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity through the lenses of technical analysis and behavioral finance. Focus on what the charts are telling us. And as I've often told people, and as I was taught early in my career, the reasons why the charts look the way they do often become very, very clear down the road. Much later, we will get a lot more clarity as to why interest rates go lower at this juncture, or why gold prices do a certain thing, or why Bitcoin comes off of resistance. At the time, the chart, I would argue, is the best thing to use to understand the trajectory of the markets, to understand where it's headed. The reasoning, the why, tends to be later. We can speculate as to the why, but the price tells us the what and the when, and I think that's what's arguably most important. I mentioned it being hazy here in the Pacific Northwest, and certainly the wildfires are affecting many, not just here, but a couple of my guests last week in the Northeast were talking about the impacts of the wildfire season here. So certainly hope everyone stays safe through that, and with all the other things we have going on, as if we needed more things to worry about. We have fantastic guests on the show. Last week was a lot of fun with some really fascinating discussions with top experts. This week, I'm super excited for these three guests. Tomorrow on August 3rd, we have Andrew Thrasher from Thrasher Analytics. On Wednesday, August 4th, Sam Stovall from CFRA Research. Sam literally wrote the book on sector rotation. It'll be a lot of fun to talk with him about what he's seeing. Thursday, we have one of the legends in technical analysis, Mark Chaikin, creator of Chaikin Money Flow, and a lot of work on advanced decline and the marriage of fundamental and technical analysis. Should be fun catching up with him this week as well. So three fantastic guests. As a reminder, if you've missed any of our previous guests, of which there have been many and really, really fantastic discussions, go to stockchartstv.com, or on our YouTube channel. You can catch all of the previous episodes of the show. Continuing on here with our three-fanged approach, our three-phased approach here. Step one is the macro environment. Let's get to our market recap. So as I mentioned, sort of distribution, the key word today. The morning opened kind of strong. We opened around 44.20 on the S&P, quickly came off of that level. Two big sort of distributions, one going right into lunch, the other going into the close. And the one going into the close is a little more concerning. We haven't talked a lot recently about that last hour, but there's a lot to be said about the first 30 minutes of trading and about the last hour of trading, and especially the last hour of the distribution that we saw, which took the S&P from being in the positive around 4,400 to being negative for the day around 43.85. Now, again, that's just one day, and it's just 0.2%, so that's not the end of the world by any means, but always interested to see when the market's attempting to make new all-time highs and then distributes through the trading day. That speaks more to distribution than accumulation. And while the short-term movements in one day are not the trend, days like this strung together is what causes the market to stop going higher and really start to pound its way lower. So something to watch, in particular, advanced decliners. I'll try to remember to check that here before the end of the show. You know what? Why don't we go there right now? Let's do it. Let's go to advancers, decliners. I've not looked at this yet to see where we're at. See, it was kind of a mixed day here. Even though we distributed a pretty decent amount going into the close, there's still about 50-50, 53% decliners, 45% advancers. So this was not a broad distribution day like we've had at times. This was more just a middle of the road, very similar actually to the breadth data that we saw on Friday's session. Again, assuming that holds up. Our breadth data on StockCharts is usually scrubbed and completed after the close to lock in all the closing data, but something to look for, certainly through the course of this week, advancers versus decliners. The NASDAQ is actually one of the few things not down, but just a rounding error above zero, and the VIX is teasing that 20 level again, currently around 1960. Other asset classes very quickly, 10-year yields really came off today with the 10-year yield down to around 117 or so. The TLT, which is our proxy for bond prices, going higher about 0.9% to around 150. 150.67 is where it closed. So, again, I've been asked, how low rates can go. When I talk about the potential of rates to go lower, the potential of bonds to rally, I am always, people explain to me why that shouldn't happen. And days like this remind me, and I hope remind all of us, they can absolutely happen, right? There's no theoretical reason why, or there are plenty of theoretical ways that any asset class, for the most part, can go up or down at any time. And I certainly am seeing signs of further weaker rates, and you're seeing it on the strength of the chart of the TLT. We'll go there in a minute. The dollar index just a little bit below zero, but nothing too crazy. Commodities as a whole down today. Energy was one of the weaker sectors. USO, the oil price index that we tend to use, was down just under 3%. Commodities as a whole down about 1%. Gold was one of the best performing, down just a little bit, and that came at the end of the day. Cryptocurrencies certainly volatile as always. Bitcoin really came off of the 40,000 level, and what's interesting is over the weekend, it's a great chart to review, and let's go there here in a minute. If you look, the end of last week was finishing relatively strong, even though it came, really pushed up to that 42,000 level, Friday into Saturday. And the thought was, that is sort of the upper boundary that we've been dealing with, right? We've hit around 41, 42,000 a couple times here, May and June. That's the blue shaded area that I've created. This is based on Fibonacci retracements on a couple different time periods, also lining up, by the way, with the first real peak in 2021, which was the end of this big acceleration off of Bitcoin 10,000, hit a top right around 42,000 and came off. So there are a number of reasons why that level has had meaning for Bitcoin. So it's not surprising we've bounced right up to it. Over the weekend, we distributed right back and sort of came off, and now we're trading below 40,000 again, and actually testing 39,000 or so. So it's worth remembering some of those key levels, especially with cryptocurrencies. I'm actually doing an interview later this week, all on cryptocurrencies, particularly on Bitcoin. One of the things we'll talk about is when you have an asset class like this that's very volatile and very uncertain, and certainly there are reasons why this could or should go higher or lower when you think about the narratives behind it. At the end of the day, it's an exercise, I would argue, in support and resistance. It's all about price levels when there is rampant speculation, which there absolutely is. And so it's worth focusing, it's worth looking at where we're at and looking to the left on the chart and keying in on key levels. Well, the way I see this chart evolving is you basically had the acceleration into the April peak. We then had a distribution phase into May. We talk about still being in a distribution phase, but now that we've bounced so much, you can see that this is really sort of a consolidation between 29 to 30,000 and 42 to 43,000 or so, right? And we're sort of in that range bound scenario, which is quite a wide spread, of course, but those are the levels I would be paying attention to and just see at which point do you see momentum take control. Do we have buyers pushing the price out of that range to the upside, or sellers taking control and pushing the price to the downside of that? Next chart I want to look at in this macro category is the TLT, and what causes me to think more about lower rates than higher rates is just the overall trend. Now, what you had is this big move higher in bond prices out of the low in March. This is when the 10-year yield comes down to 175-ish or something like that. And then since then, you've sort of had this stabilization period as prices went higher, and you've seen rates come off quite a bit. You have this bearish engulfing pattern on the TLT, which ended up being a beautiful tell about short-term distribution. We can see we gap down significantly the next day. From there, though, we've been building up further momentum. We keep making a pattern of higher highs and higher lows. And again, I'll assume that sort of trend continues until proven otherwise. The other thing that's really telling is the RSI. This is a great illustration of RSI being in different ranges. It was clearly in distribution range from last August to September to, say mid-April, May, early June, when it flipped back to the positive range. You can see the RSI never really got above 60. It started to get above 60. Used to be oversold. Now it's nowhere even near the 50 line, much less the 40 line. So as a result, this is much more in a constructive pattern. This is a chart in an uptrend. It's bounced off of this Fibonacci resistance level a couple times and now is rotating higher. So, again, until we put in a lower high, which could happen this week, that's what I would be looking for, is if we're able to eclipse the upper end of this bearish engulfing pattern from a couple of weeks ago. But if you ask me to identify what overall trend we see here, this is a bullish trend in bond prices until proven otherwise. I think there's further upside in that chart, which means further downside in rates. We could talk all about why rates shouldn't go down, but the market doesn't care the reasons why it shouldn't happen. If it does, it does. And I would focus, as always, on the charts. We need to finish up just briefly looking at the S&P chart, and then we'll get to the sector rotation. So not a huge day, obviously, a bit of a distribution, obviously, through the course of the day. I don't want to draw too much into that because we're coming off of new all-time highs last week. We spent much of last week above the highs for the previous couple of weeks. And so we've continued to make this pattern of higher highs and higher lows. If we do get a pullback, I would absolutely be looking at the 50-day moving average, currently around 42.90. That has served as support numerous times in the last 6 to 8 months, and I would expect that to continue. The moment it does not continue, the moment we hit the 50-day and fail, I would expect an acceleration to the downside, because that would be a key signal to a lot of investors that the 50-day is no longer holding as support. There's potential for further downside. Until then, there are plenty of charts still going higher, and we'll look at some of those here in our shifting stock segment. Our next segment today, though, is sector setups. What we're going to do is look at the 11 S&P sectors, talk about how they're rotating around the S&P 500. We like to do two things in this one, three things really. Number one, start with the RRG. This is Julius de Kempener's beautifully designed visualization that shows the trajectory of the 11 S&P sectors relative to the benchmark. In the middle, check out his show Sector Spotlight if you're not familiar with this visualization. Then we'll look at the candle glance and talk about some big picture takeaways. And then we'll look at a couple of the individual sector charts and see what conclusions we can draw about the overall rotational environment. When I'm looking at the RRG, which I do often, I look at this pretty much every day, but every Friday I write a note to clients with this as part of this on a couple different timeframes as part of it. And really the story in recent weeks has been this severe rotation away from cyclicals. This is using longer term data. This is using weekly data. But you can see that all the cyclical sectors, energy, financials, materials, industrials, are heading southwest. They're continuing to deteriorate. They're both in the weakening quadrant as well as the lagging quadrant. One by one, they've been going into that lagging quadrant. That is not where you want to be as an investor, generally speaking. You want to be in positions of strength. You want to see what's improving and starting to get better. Real estate has been, or had been, the only sector in the leading quadrant for a little while here. It's overall still the strongest, and furthest to the right means it's the strongest over that time period, but you can see the momentum's coming off of this, and this is something to pay attention to. A lot of times a fairly constructive pattern is where you get sort of a cyclical pattern to the right side of the zero line that tells you that it's still outperforming. It's just sort of impulse and corrective moves within that uptrend. That's actually a pretty healthy pattern. So looking to see if we get that sort of rotation back to the north would be interesting on real estate. And overall, obviously, still plenty of strength there. But the real impressive moves are the ones heading northeast into the improving quadrant and also right into the leading quadrant. Two are doing that: technology and healthcare. And when I've been screening for stocks making new highs, last week, Wednesday into Thursday, I screened on a bunch of different things. And the two sectors I'm finding the most actionable ideas are, you're right, technology and healthcare. So I'm not surprised to see that these sectors are bubbling up to good strength. And what's interesting about healthcare is what we had talked about a lot were things like medical supplies. And I think on Friday, that was one of our 3 and 3. Actually, I think one of the 3 and 3 was healthcare. The other was the medical supplies group, which has some of the stronger charts. Things like EW and PKI and others that have had nice, pretty good runs. But what's interesting in healthcare is it's not just those. I mean, it's a little of everything. This is Pfizer making new all-time highs today, up 2.7%, breaking above, really has broken last week above the December high from last year, but really pushing to the upside. And this is on a pretty high-yielding name as well. So you have capital appreciation. You also have the dividend component, which is fairly significant relative to the average yield you get on a benchmark name. So actually a nice sort of move in healthcare. And again, I think the fact that you're seeing some of the larger names, things like Pfizer and others that are showing constructive patterns, I think it's pretty interesting. Moderna, by the way, reports earnings Thursday before the open, I think, mRNA. So something to watch there, of course. Another heavy earnings week, by the way. We'll get to some of those when we get to our shifting stocks segment. Let's look at the candle glance function. So this is a beautiful way to take a list of anything, use the chart list feature, put the tickers in there, and then view the list as a candle glance page. You know, in my former life at a large buy-side institution, we used to print out an embarrassing number of charts, probably thinking back. We had a lot of paper charts, but it was the way that we would do it. We draw a lot of lines and notes on the paper charts. But one of the things I would love to do would be dump the pile of charts on a table and just start sorting the piles into really good, pretty good, okay, bad, and doing that consistently. You could see when you finished it and your bad pile was huge and you had very little in the really good pile, you didn't have to look at a chart of the S&P to understand that it was a sort of a distribution phase, or sort of a negative phase. So this is sort of the electronic equivalent of what we would do there, which is basically taking the charts, looking at all them together, and then just taking a step back and seeing what sort of patterns emerge. What's interesting when I look at this, as always, I like to start thinking of where each of these are relative to their significant moving averages. What are above their 50 and 200-day moving averages, both of which are sloping higher? Those are really good places to start if you're looking for opportunities. And the ones that fit the bill: communication services, consumer discretionary, surprisingly consumer staples, healthcare, utilities, technology, real estate. That's it. Everything else that I did not mention is actually back below its 50 and or its 200. None of them below the 200-day moving average right now, but all the rest of those are all below their 50-day moving averages. You know, from there, it's important to look at the relative strength, and something like consumer staples, while above its 50 and 200-day moving average, that's great. The relative strength line tells a fairly painful story, and even though there are pockets of strength in any of the sectors, including consumer staples, Costco is the example that we've talked about pretty regularly. Now, the fact that relative strength overall has been deteriorating tells me, as a sector rotation strategy, something like staples is not a great opportunity, because it's demonstrated its inability to outperform in literally any environment. That's not what you want to build a portfolio around. Compare that to something like healthcare, where you're really starting to see some emerging relative strength. Look at how that, again, looked a lot like consumer staples until about a couple months ago, maybe the last 4 or 5 months, when you start to see the relative strength rotate from downtrend to sideways, and now arguably back to an uptrend, making a 6-month relative high again this week. I like the rotation in healthcare, and we've talked about things like medical supplies, medical equipment, where I think there are plenty of strong charts that remain very constructive, but it's also some of the big pharma names and others that are really showing some relative strength. That's why the healthcare as a whole, healthcare sector as a whole, has been a pretty decent bet. Technology, of course, is the other one. You've seen the relative strength emerge here. The question is this the end of the move, the last gasp higher? And again, I will put the benefit of the doubt on the chart. Follow the trend, and when the trend stops going higher, that tells you to stop supporting it. And what we've seen in the chart of technology for the last month or so, if not further back, is a continued pattern of higher highs and higher lows. Most recently, the XLK putting in a higher low last week. So watch that pattern to continue. When it doesn't, so which would mean a break below 147.50 on the XLK, that's when you can start to be concerned about potential further downside. We need to take a quick break. We'll be back with our final segment, shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in the markets using charts. And again, what I've often told people is the order of operations, the way you should think of things, is very important, right? In terms of the process. I think good investing performance, good investing routines are built on discipline and consistency. And I've always reminded people an imperfect but consistent routine will always do better, and not always with an asterisk. Most of the time, if not always, will outperform a perfect but inconsistent routine. Consistency is much better than idealizing your strategies and your charts. Doing something consistently, even if it's pretty good, is going to be much better. The consistency is key. So it's all about having a pattern. The pattern we advise on this show is going through the process we do every Monday. Start big picture, look at sectors, look at stocks, and if you're investing in equities, that is a process I would encourage you to follow. Make sure you understand the trajectory of the big picture as well as the micro as well. A couple quick announcements before we continue on. Questions We would love to hear particularly questions on technical analysis, on the markets, on particular charts, technical indicators, whatever it is, we're here to help point you in the right direction. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube, and we just passed 50,000 subscribers on our YouTube channel, which we were super excited about. Join us there if you have not already, and put a comment below the video that you're watching. We'll gather all those questions and hope to answer one of your questions in our next mailbag segment, which will be on Tuesday's show of this week. Also, go to stockchartstv.com, use your email address, set up a free account. You can start watching all of our fantastic content on demand from our website, also from all of your mobile devices. Just go to the App Store and search for StockCharts TV on demand. Our next segment today on a Monday, we've talked about the big picture. We've talked about sectors. Now let's go to the stock level for shifting stocks. What we're going to do is go through a number of places. One, I just wanted to mention, I saw somewhere about GE being up 600 some percent, and it caught some people off guard. They actually went through a 1-for-8 reverse split on StockCharts. If you want to unadjust the data, all of our data is adjusted for splits and dividends and things like that to smooth out the price data, focus the analysis more on the behavioral implications. We want to drive it. We want to drive our analysis based on buy and sell decisions and less on capital changes and splits and stuff like that. So all of our data by default is smoothed out. That was a John Murphy decision years and years ago in the early phases of StockCharts, which is why your technical indicators make a ton of sense. If you unadjust the data, so put the little underscore in front of the ticker, you will see what actually happened today, which is the stock went from 12 something up to 100. And that's why it's up a ridiculous amount. This is why we adjust the data, because all of your indicators and relative strength and everything, if you don't account for splits by adjusting the previous data, you get these really weird things that happen on your charts because you're pricing in something or you're incorporating something and basically making the assumption that it's based on buying and selling, supply and demand, fear and greed. And it was just a structural change in how the stock was done. It was really seemed to be done to reduce the shares outstanding, put it at a more reasonable price level. So that is what happened with GE. Overall, from a technical perspective, I would say very little to get excited about on the chart of GE. It reminds me of some of the other charts we've talked about recently. PayPal comes to mind as something that is stalled at previous highs. And I think the story of this market, if we do sell off from here, I would say one of the best tells have been so many charts like this that have had a chance to make it to new highs and either have failed to do so, failing to break out, in this case above 115, or just connecting the previous highs, or unable to adapt to or breaking out and not actually falling through. And that's what we had on the chart of Amazon and Apple and others, which we'll look at here momentarily. PayPal is a really interesting one, by the way, and again, this is why it seems similar. It hit the 310 level here in February, hit it again last week, and then gapping lower on earnings last week, continuing to sell off again today, down about 1.7%. We did the pitch recently. That was last week or the week before. I think it was last week. Had a great discussion with three analysts. Greg Schnell, Mark Newton, and Jeff Hughes did a great job. And the one consistent group all three of them picked in their 5 stock picks were payment processors. We had PayPal, Square, and MasterCard all identified as good long-term plays. So it's interesting that you're seeing some distribution in that group, particularly PayPal with the gap lower on earnings. You've had some stocks that are really disappointed on earnings, and you're seeing some downside rotation there for sure. Looking at some of those other ones, MasterCard like this, and it's not a bad chart. It's just not a great chart. And you can see the relative strength overall has been relatively painful. It's testing a new 12-month relative low here. It'd have to pull back a little bit more to actually do so. Visa probably better of the two, although again, the whole group is getting hit pretty good today. Moving to the downside, Square was the last one that I mentioned out of the group. This is the one bumping higher, up 10% today. And what's interesting on the chart of Square is just like PayPal failed to get through its previous highs, Square is now approaching those right here around 280 or so. So it might be a really important chart to watch through the course of the week. Other things very quickly, when I'm looking for charts that are emerging, specialty finance is one of the group that ranks the highest. I was actually looking at the top industries here. This is using the Dow industry groups. There are about 106, I think, industry groups. This is a chart list that I use to look at the sectors and industry groups, and I love to sort them based on their scooter rankings just to see the strongest and weakest, and what sort of patterns are emerging. Specialty finance is one of the 5 top groups right now. And again, if you're not looking at materials, it's interesting, kind of aluminum and steel. Aluminum is kind of a weird group. Besides Alcoa, it's probably a bunch of names you may not know. A lot more mid-cap names, and same in steel. Maybe worth looking at those groups to see if there are any emerging charts. They've pulled back a little bit and potentially rotating. They're really just coming off a really weak place about a year ago, 6 months ago as well, which is why they're scoring very well right now on the scooter rankings. Specialty finance is a really interesting group. If you think of the financial sector and the pain on a relative basis of charts like JP Morgan, was just have stopped going higher and now just look a lot like a head and shoulders top. And I would caution you on a chart like this, you are not allowed to call it a head and shoulders top until you break what's called the neckline. The way the chart patterns work is you have a high surrounded by lower highs, which you definitely do. You then have a neckline, which you have a very clear neckline just above 145. You take that low, connect it to that low. We tested it here a couple of weeks ago and bounced off of it. You need to break that neckline. Once you do, that's when the pattern is confirmed. And that's when you can say that was a head and shoulders top and it measures a lot lower. It's not triggering it yet, but certainly with rates coming off, would not be surprised to see that continued downside pressure come out. But within financial sector, we have a lot of charts that are feeling some pain. You also have things like this, which are in the specialty finance group. MSCI up 2.5%, extremely overbought, making new price and relative highs consistently over the last month or two. Same group, what else is in here? Like SPGI is in that group with a nice breakout to the upside. Moody's, I want to say we've talked about, not bad, maybe pulling back a little bit relative to the others, but still strong relative strength. So it's interesting to point out that within even sectors that are technically challenged, there are pockets of opportunity most likely. I think that's what happened in healthcare. We had things like supplies and equipment that were doing very well, while some of the other names were struggling. Biotech and pharma were struggling, but now you're seeing a bit of a rotation higher across the board. Worth noting in a sector like financials, there are pockets of strength in there. Just to finish off here, then we have to be done. Again, Amazon, the chart certainly has gone from one of the more constructive breakouts that I've ever seen, which is this 10-month base resolving to the upside. This feels like a layup. We are going to go significantly higher. And that breakout measures very high into the mid 4,000s, 4,300, if I remember right. I'm totally back of the enveloping that, looking at the chart, but it was something like that. But if you look at what's happened since then, is it's a failed breakout. We've now made a lower high. We then gapped down into last week into today, continuing to sort of chop around in that level. But we're literally mid-range of that basing pattern still. Charts like this do not make me feel confident about unlimited upside for stocks. They make me think more about the potential for downside as opposed to potential for upside. We need to wrap the show though and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the TLT, the long bond ETF. We talked about this in our first segment. Again, if there's one thing that you take away from the show, it's to remind you that if someone says rates can't go down because of blah, gold can't go higher because of blah, Bitcoin can't go lower because of blah, please do not listen to that. Things can go up and down, and the reasons why they can do that become clear down the road. I will never forget, during a bull market in stocks, gold prices went straight up. They kept moving higher. And I was told all along the way why gold prices can't go higher when equities are rallying that much. And then I just watched both of them go higher. So please don't believe a narrative just because it's a narrative. The charts can do a lot of different things. And when I'm looking at the chart, I'm seeing bond prices go higher. I'm seeing yields go lower. And I don't see a reason from a technical perspective that needs to change. Chart number two is Bitcoin. This became overbought right at this congestion area we've talked about. We've had these lines on the chart for months, and I think they are still very much in play. These are the two areas that I'm looking at, around 30,000, around 42,000. I see this chart as range bound until proven otherwise. We're very interested to see what the pullback scenario looks like this week and if we can establish a higher low. Finally, your PSA for today, your public service announcement, is always look for charts making new price and relative highs. The Specialty Finance Group scores very well using our industry scooter rankings, and it also happens to be making new price and relative highs last week and again so far this week. Extremely overbought, which means at the least you probably expect a bit of a pullback before at least one more move higher. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.